Hello and welcome to lecture number 7. We're going to be discussing credit and inventory management. This comes from chapter 20 of your book. So the key concepts and skills that we'll cover in this lecture are we're going to explain how firms manage their receivables and the basic components of a firm's credit policy. We'll analyze a firm's decision to grant credit. We'll define the types of inventory and inventory management systems used by firms, and we'll determine the costs of carrying inventory and the optimal inventory level. So all of these decisions, all of the things we're going to be discussing today will potentially affect revenues. They will affect the cost associated with those revenues. And so if we can manage costs to keep them low, if we can manage revenues to keep them as high as possible, then the firm will be more profitable. And that's our goal as financial managers, is to increase profitability to the firm. So what are the key issues in credit management? Well, generally speaking, when we grant credit, it will increase our sales. Granting credit means we will let people buy something today and pay us at some future date. And so we'll have to pay it, but we don't have to pay it on the day that we buy it. It's a lot easier to buy things if you don't have to pay for it right then, and people are more willing to purchase. There are costs associated with granting credit. There's a chance that customers will not pay. We call that bad debt when customers don't pay. We also have to finance our receivables. We'll talk a little bit more about this. We had to manufacture or provide the product somehow. We had to pay for that, and we continue to pay for it while we're waiting for the customer to pay us, while it's sitting in receivables. So credit management examines the trade-off between increased sales and the costs of granting credit. So we're trying to find an optimal level here in order to maximize revenue and income. So components of a credit policy, there's the terms of sale, a credit period, so how long before they need to pay it, cash discount and discount period. Often there's a discount if they pay it earlier, and the discount period is the period in which they'd have to pay it early in order to get the discount. We'll give an example here in a second. Also, the type of credit instrument. So credit analysis, we're distinguishing between good customers that will pay and bad customers that will default. So this is where we talk about bad debt. When a customer buys something but never pays us, it's sitting in receivables, and they're bad customers because they didn't pay us. And so that's a bad debt on their part. Our collection policy is an effort expended on collecting receivables. So how much effort are we willing to make in order to try and collect? Are we willing to call the customer every day until they write us a check? That takes time and effort and worry. So there are costs associated with these decisions. So this shows a timeline of cash flows from granting credit. So time here, we've got the initial point where the credit sale is made. So the customer walks away with the product, but we don't have the money yet. So credit sale is made. And so now we have an accounts receivable. The customer owes us the money, and so it's on our books. The customer at some point will mail a check. Obviously, there are electronic versions of this, but the customer mails the check. It's received by the company, and the company deposits in the bank. And eventually, a day or two later, the bank credits the firm's account for that check. So this period right here is what we call the cash collection period, from the time the customer mails the check to the time that it's credited to our bank account. This is considered to be accounts receivable. However, one little thing, in most accounting systems, when the firm inputs the check into the accounting system showing that it's been paid, this would be the end of the accounts receivable timeline. within an accounting system. But really, it technically will last until it's credited to the bank account. So a little bit more on terms of sale. Here's a basic form, very common. You might see 210 net 45. So the 2 is the discount. It's a 2% discount if paid within 10 days. So I've seen 210, I've seen 110, I've seen 215, and this could be net 30. The total amount due in 45 days if the discount isn't taken. So what this means is if the customer pays within 10 days, then they deserve a 2% discount off of the invoice amount. If they don't pay it within 10 days, then they have to pay the full amount within 45 days. And if they don't pay it within 45 days, then they are late, and some companies will at that point start charging late fees. So let's say we're going to buy $500 worth of merchandise with the credit terms given above. So we've got $500. So what we'll pay if we pay within 10 days, we're going to pay $500 times 1 minus 2%. So that is $490. So we save $10 if we can pay it within 10 days. So if we don't pay it within 10 days, then we have to pay the full 500. So now let's do a quick example on cash discounts. So we're going to find the implied interest rate when customers do not take the discount. What is it costing us when we look at the time value of money and the discount that we're being offered? What does it really cost us in the effective annual rate as we look at this? So the credit terms, again, were 210 net 45. So our periodic rate is 2% divided by 98 gives us 2.0408% is the cost within the period. And our period is the 45 days minus the 10 days. So our period is 35 days. And how many periods per year are there? Well, if we take 365 days divided by the number of days in each period, we'll get 10.4286 periods per year. Okay, so this is the number of compounding periods, if you want to think of it in that way, earning this 2.0408%. Okay, so in order to determine what the equivalent or effective annual rate, we're going to take 1 plus the period rate, 0.020408, to the 10.4286 power. So this is the number of periods per year minus 1. And so this equals 23.45%. So if we don't take the discount, we are basically saying, okay, we're okay paying 23.45%. We could save this amount if we pay early, pay within the 10 days. So the company benefits when customers choose to forego a discount. When acting as CFO at the company I work for, we watch this carefully, and we didn't mind it when customers didn't take advantage of the periodic rate. But in paying our suppliers, we were very careful to watch the discount periods and to try and take every discount that was made available to us. So when the customer doesn't pay early, they're paying basically an additional 23.45% annually. Okay, so there are certain effects that come along with credit policies. The first type of effects affect our revenue. So there's a delay in receiving cash from sales. So we've sold something and it takes some time to get the money, but we may be able to increase the price. Sometimes you can, if you offer credit, you can charge a little bit higher price for your product. Also, it may increase total sales. And you see this, I saw this absolutely. If we could pay for it later, we're happy to buy it today. And so in general, it'll increase total sales. Now on the cost side, the cost of the sale is still incurred even though the cash from the sale has not been received. So whether we're paying commissions or other costs related to the sale of that item, we have incurred those costs, but we haven't received the money for the sale. Also, there's cost of debt. We have to finance those receivables. And so we've paid for the inventory, we've paid for all the selling expenses, but we've not received the money yet. And we won't until it's paid at some point down the road. It sits in receivables. So we are basically financing the purchase for whoever is the customer. Also, there's a probability of non-payment. There's a chance that they will not pay. Some percentage of customers will not pay for products purchased. Finally, the cash discount. Some customers will pay early and pay less than the full sales price. So we lose out on that money as well. So we've got some positive things, we've got some negative things. How do we evaluate it? Well, let's look at this example where we're going to evaluate a proposed policy. So our company is evaluating a switch from a cash-only policy to a net 30 policy. So up to this point, we've only accepted cash. And when we say cash, they have to give us the check that same day. They have to pay with a credit card that same day, or they have to actually give us a physical cash for us to receive that. So in this example, the price per unit is $100 and the variable cost per unit is $40. The company currently sells 1,000 units per month, but under the proposed policy, the company expects to sell 1,050 units per month. So this is an additional 50 units because we are now offering credit. The required monthly return is 1.5%. So this is our discount rate. We'll look at this. So what is the net present value of the switch? Does it make sense to switch? We're going to get more customers, but there's a cost of financing the accounts receivable. Should the company offer credit terms of net 30? So now let's do the analysis and see. So we're going to have an incremental cash flow. Remember, there are 50 additional units sold. Each unit has a certain amount of variable cost to it. So the difference between the purchase price and the variable cost is what we would call an incremental cash flow. So here's what the unit costs. This is what we charge the customer, and this is what the variable cost is. So the difference is $60, and that's the incremental cash flow per unit. And you can see we've calculated here 1,050 minus the 1,000. We've got 50 additional new units. So our total incremental cash inflow from changing the policy is $3,000. So what's the present value of this incremental cash inflow? Well, what we do, this is a perpetuity formula. We're assuming that this change will go on in perpetuity. And so this $3,000 will continue to happen each month. So we've got $3,000 divided by the discount rate, our required rate of return of 0.1 or 1.5%. So the present value of the incremental cash flow is $200,000. So this is what it is worth to us because of the additional sales that we're going to get. This is the present value of that. But there's the cost side of this. What is the cost of switching? Well, we've got the $100 times the original 1,000 plus the $40 variable expense times the 50. So we've got 102,000 is the cost of switching. So let's look at the net present value of switching. The net present value, we take the present value of the incremental cash inflow minus those costs associated with switching, and we're left with $98,000 positive. So the NPV is positive. So as we know, our decision rules when we're looking at NPV, if it's positive, we accept the project. If it's negative, we reject it. So the company should switch in this example. Okay. There is a cost of granting credit, and we're going to discuss two types of costs that make up total cost of granting credit. The first one is called carrying costs. Carrying costs are made up of the required return on receivables. In the previous example, that was 1.5%. We are financing those receivables. Losses from bad debts. This is when customers don't pay and we won't ever get them to pay. We have to write it off. Finally, costs of managing credit and collections. So we have to look at accounts receivable. We have to have people on our staff who are helping to collect those funds from customers. So these are the carrying costs that are associated with granting credit. There are also shortage or opportunity costs. So if we don't grant credit, there could be lost sales due to a restrictive credit policy. Customers may not have the cash today, but maybe they'll have it in just a few days. We'll potentially lose the sale entirely if we have a restrictive credit policy. So these two together will make up what we call our total cost curve. It's a sum of carrying costs and shortage costs. So the optimal credit policy is where the total cost curve is minimized. I'll show you in a graph here. This is our total cost curve. And what we're looking for is the point where this is the optimal amount of credit where the total cost is minimized. So the total cost is made up of these two curves. We've got the carrying costs, which goes up with the amount of credit extended. So the more credit we extend, the more chance, the more lenient we are on our credit terms, the more chance that people will default and we'll end up with bad debt. On the other hand, opportunity costs, if we don't offer credit, we may lose sales. So the more credit we offer, the more sales we will receive, and so that reduces the costs. So when where these two meet is where the optimal amount of credit is. So again, carrying costs are the cash flows that must be incurred when credit is granted. They are positively related, meaning they slope up to the amount of credit extended. Opportunity costs are the lost sales resulting from refusing credit, and these costs go down when credit is granted. So we're trying to find the sweet spot where we minimize the total cost of granting credit. So most companies who offer credit will do some form of credit analysis. This is the process of deciding which customers receive credit. We've got an alumni who is currently working in credit analysis for Adobe up in the Silicon Slopes area of Utah. So in order to do this, we have to gather information about the customer. We need to gather financial statements, credit reports. This tells us whether or not they've been paying their other vendors, banks, and any payment history they already have with our firm. So this is all the information we're going to gather so that we can try and make an informed decision about whether or not to extend credit to this customer. So how do we really determine credit worthiness? Is the customer really worthy for the credit? Will they pay us back? And we'll talk about these a little bit later on, that we have the 5 C's of credit. Each C represents something else. Also, there is credit scoring that can be done that will help us to determine credit worthiness. So when should credit be granted? Let's look at our first scenario. If it's just a one-time sale. So this is not an ongoing customer. We're going to sell something and it's likely going to be just a one-time sale. So we've got to look at the net present value of selling to this customer. And here's our formula, and we'll define each of these terms here. V is the variable cost per unit. So if you'll remember in our previous example, the purchase price was $100 and the variable cost was $40. So we need to know that. The variable cost per unit. Pi represents the probability that a customer will not pay. So we want a low probability that the customer will not pay. P is the price per unit. That was $100 in the example that we had before. And R is the required return on receivables. You'll remember in the previous example, R was 1.5%. So if the NPV is positive using this formula, then credit should be granted. So here's our example of a one-time sale. Our company is considering granting credit to a new customer. The variable cost per unit is $50, so V is $50. The current price is $110, that's the purchase price. And the probability of default is 15%. So we're 85% sure that the customer would not default. There's a 15% chance the customer will default. The monthly required return for this firm is 1%. So R is 1%. So let's plug these numbers in. 50, you can see 1 minus the 0.15 times our purchase price, divided by 1 plus our rate, which is 0.01. So net present value is 42.57% positive. So that tells us, yes, it would make sense to extend credit to this customer, assuming we had estimated each of these correctly. The one to really look at is the probability of default. What is the true probability of default? So what is the break-even probability? How high could this probability of default be before we stop offering credit to customers? Well, what we do is we set NPV to 0. So what we're trying to do is solve for pi, which is the probability of default. So we plug everything else in, set this equal to 0, and we solve for pi. So in this case, pi, the probability of default, could be as high as 54.09% before we stop granting credit to customers. So that's a pretty good situation to be in. So when should credit be granted for repeat customers? Now, this was just a one-time sale, but a repeat customer brings continued business. So we're going to look at this from more of a perpetuity standpoint. So you'll notice that our formula is a little different. We've got our NPV is equal to negative V plus 1 minus pi times P minus V. So this is one thing that's different from the previous, divided by R, just R, not 1 plus R. So this is assuming sort of a perpetuity situation. So in the previous example, what is the NPV if we are looking at repeat business? So in this case, we'll plug in the minus 50, 1 minus 0.15, 110 minus 50 divided by 0.01. So the net present value for this is $5,050. And that's significant as we consider the value of a repeat customer. Repeat customers can be very valuable, hence the importance of good customer service. It's much better to keep a customer than to try and find one. So it makes sense to grant credit to almost everyone once, as long as the variable cost is low relative to the price. If a customer defaults once, you don't grant them credit again. Okay, so now let's talk a little bit about the information that we use to determine whether or not to grant credit. The first is our financial statements. So when I worked as CFO, we dealt with many suppliers and we requested credit from most of them. And in most cases, they would send me a form that I needed to fill out, which had information that I would write in, but they would also ask me to include our audited financial statements so that they could review them and see how strong financially our firm was. They would also pull credit reports with our payment history to other firms. Often in the industry I was in, they would also ask for references from some of our other suppliers, and they would call those other suppliers and say, hey, does this company pay on time? Are they good customers? What do you think? Also, we would often have to provide information about bank balances and or if we had lines of credit and what those lines were for. And finally, the payment history with the company. If we've done business with them before and paid them before, they're more likely to grant credit to our company. So what are the 5 C's of credit? Character, the willingness to meet financial obligations. If the supplier thinks that you have a commitment to be ethical and meet your financial obligations, they'll look at you as having good character. Capacity, the ability to meet financial obligations out of operating cash flows. So are we earning enough money to pay our bills, or are we having to go to other sources of financing, such as debt or equity, in order to meet our financial obligations? Capital, what are our financial reserves? How much do we have in the bank? Collateral, also sometimes they might require that we pledge assets as security. So if we don't pay, they can come and take those assets. Conditions, what are the general economic conditions related to the customer's business? So this is extremely relevant to us right now. We're in a recession as a result of the COVID-19 pandemic. I can guarantee you there are a lot less people being granted credit during this period, all things being equal, than in normal economic conditions. And that's because the risk of default has gone up because of difficult economic conditions. Most firms will also have a collection policy. They'll monitor receivables. They keep an eye on average collection period relative to your credit terms. So I would have my staff print me out an aging report for our accounts receivable so that I could see exactly who hadn't paid and how long they had been outstanding. So using an aging schedule to determine percentage of payments that are being made late, we would use that information, and I would call the customer and say, why haven't you paid? What do we need to do to get ourselves paid? There's also the process of collection. If a call doesn't work, we can also send a delinquency letter, the telephone call, and then if worse comes to worse, we can give it to a collections agency. What typically happens with a collections agency is they will be able to get a percentage of what is outstanding. Finally, you can take legal action. Hopefully you don't ever have to get here. If you've had a good credit policy and made good credit decisions on whether or not to grant credit to customers, you'll rarely have to make it to this legal action phase. We had one scenario where the customer just was not paying, and we were patient. We made phone calls. We sent statements and reminders. We decided not to send it to a collection agency. And finally, after multiple months, we had to call them and say, you know, we're being forced to take legal action now because we've remained unpaid. And just the threat of legal action made it so that they got us paid that week. And so you don't want to do that. You want to work in good faith and have good relationships, but eventually sometimes the gloves have to come off and you have to take legal action. So that was about the credit policy. Now we're going to move into inventory management. There's some similar concepts as we look at inventory management, as you'll see coming up. So inventory can be a large percentage of a firm's assets. It really depends on the business, but some businesses require a significant portion of their assets to be in inventory. And there could be significant costs associated with carrying too much inventory. So firms are trying to limit the amount of inventory so that they don't have too much. There can also be significant costs associated with not carrying enough inventory, such as lost sales. And so You're looking for, again, a sweet spot, similar to our credit policy, where we're trying to minimize the potential cost related to credit, issuing credit. Here, we're trying to minimize the total cost of having inventory. So inventory management tries to find the optimal trade-off between carrying too much inventory versus not enough. So there are different types of inventory. For a manufacturing firm, it might be raw material, starting point in the production process. Also, there's work in progress, so they're somewhere along the manufacturing line. And then we've got finished goods. These are products ready to ship or sell. Okay, so our inventory could be at any point along this continuum. So remember that one firm's raw material may be another firm's finished goods. So if we are ordering raw material, we're ordering it from somebody. They've probably extracted it from the ground. And so their manufacturing, if you will, is to get it out of the ground and get it ready to be shipped to their customers. So there are different types. The different types of inventory can vary dramatically in terms of liquidity. Some are easy to sell, some are virtually impossible to sell. So let's look now at the costs, the inventory costs. We already mentioned carrying costs. And carrying costs of inventory range typically from between 20 and 40% of the inventory value per year. You have to store and track that inventory. There's insurance and taxes on that inventory. And if it stays in your inventory for too long, it could become obsolete. It could start to deteriorate, or it could be stolen. So for the firm that I worked for, we were electrical contracting firm, and we kept as little inventory as possible. We would order the inventory the night before and have it delivered directly to the job. So it never hit our storage facility. We didn't have to track it, it went straight to the job. We didn't have to insure it because the job site was insured. And we reduced potential losses due to obsolescence, deterioration, or theft. Also, there's an opportunity cost of capital. If we have too much sitting in inventory, we paid money for that inventory. What could we have done with that money if it wasn't sitting in inventory? So those are the carrying costs. Now we're going to talk about the shortage costs. There are restocking costs, so reordering. Lost sales or lost customers. If you don't have it, they're going to go someplace else and buy it. So we have to consider both types of costs and minimize the total cost. So this graph looks very similar to the one with the credit policy. We've got our carrying costs. This is they're greatest when there is a large quantity of inventory on hand. So the bigger the Q, quantity of inventory on hand, the higher the cost of holding that inventory. The restocking costs, on the other hand, are greatest when the firm holds a small amount of inventory over here. And as we add more inventory, the chances of us running out get less and less. So the restocking costs, it gets less. So this total cost curve of holding inventory, we want to find where it is minimized. This Q, the quantity, is the amount that we want to keep on hand. So we've got a few different inventory management approaches that we can look at. The first one is the ABC approach. This is where we classify inventory by cost, demand, and need. So the items that have substantial shortage costs, if we run out, it'll cost us a lot. Those should be maintained in larger quantities than those with lower shortage costs. Generally, we maintain smaller quantities of expensive items. We don't want a whole bunch of expensive items sitting around. We, however, want to maintain a substantial supply of less expensive basic materials, things that we're going to reuse and reuse and reuse. So that was ABC. There's more on ABC in the book that you may want to look at. Also, there's the EOQ model. This is the economic order quantity. So the economic order quantity model minimizes the total inventory costs. So we've got a formula we're going to show, and we're going to walk through it. But we're trying to find what is the perfect amount that we should order at a time. What's the economic order quantity? So we're going to look at the two costs again, the total carrying costs. Total carrying cost is equal to the average inventory times the carrying cost per unit. So the average inventory is Q divided by 2, and carrying cost per unit is CC. Then we have the total restocking costs. We've got fixed costs per order, which is F, times the number of orders. That's the total sales divided by the quantity. So you can see Q is the quantity ordered, CC is the carrying cost per unit, F is the fixed cost per order, so shipping or whatever it may be, T is the total sales. So with this information, we can use this model in order to determine what is the optimal level of inventory to order. Okay, so what we've got the total cost, which equals our total carrying costs plus our total restocking costs. So we've got both of these formulas added together. And then what we want to do is we've got to get Q by itself. In order to do that, we rearrange it using algebra. We've got the minimum quantity to order, Q star. Q star is the square root of 2 times T times F divided by CC. And on the previous slide, Q is the quantity ordered, CC is the carrying cost per unit, F is the fixed cost per order, and T is the total sales. Okay, so let's look at an example. Consider an inventory item that has carrying costs of $1.50 per unit. So CC is $1.50. The fixed order cost is $50 per order, and the firm sells 100,000 units per year. So what is the economic order quantity? So we've got 2 times T, this is total sales, times 50, which is our fixed order, F, divided by CC, which was 1.5. We've got to take the square root of that. So when we do that, our economic order quantity is 2,582. So that would be the most ideal amount to order, the minimum amount to incur the least amount of cost associated with it. There are a few extensions to this. We might want safety stocks, minimum level of inventory kept on hand. This increases the carrying cost if we just want the peace of mind of having that stock on hand. We also have reorder points. It takes time for things, once we order it, to have it delivered to us typically. So at what inventory level should we place our next order? How low do we let it get before we place the next order? We have to account for delivery time. We also have what we call derived demand inventories. We've got materials requirement planning, MRP. This is a set of procedures used to determine inventory levels for demand-dependent inventory types, such as work in progress and raw materials. So if you're in manufacturing, you'll likely utilize that. And then just-in-time inventory. Sometimes you'll hear it called JIT inventory. Just-in-time inventory is what we practiced as electrical contractors. We would order just the night before and have it delivered just in time, the day that we needed it. So it limited carrying costs significantly. So that concludes the materials for this lecture. There's a quick quiz. I'd like you to read through each of these and answer them yourself. And if you can't answer them clearly, go back to the book or re-watch this lecture and make sure you understand the concepts. There's an ethics issue. It is illegal for companies to use credit scoring models that apply inputs based on such factors as race, gender, or geographic location. So why do you think such inputs are deemed illegal? And let me go back, sorry. Beyond legal issues, what are the ethical and business reasons for excluding or including such factors? And we might be tempted to include some of these factors, but is it ethical? Those are questions that we have to answer as financial managers. Lastly, I want you to work through the comprehensive problem on your own. The answers to this problem are found in the PowerPoint slide presentation. So if you look at the notes for this slide, it'll give you the answers, but try and work through it on your own first and see if you can get it correct. With that, we are finished. If you have any questions, please feel free to give me a call, either during my office hours or shoot me an email and we can schedule a time to meet outside of my office hours. Thank you very much.